Okay, it's Matthew Mickey here, and in the last video we learned how to know what is going on with the liquidity, and we saw where investors are putting their monies and the views on the economy, and we did this all by learning it through the bond market, right? The government bond market. We also learned that there is no rule book due to the Fed's action, and we looked at things like the short-term rates going down versus the long-term rates going up, or when we are in a transition period based off the type of economy we are going towards. We also laid on top of that volatility, and when the VIX is transitioning, we know what to expect in different asset classes. We saw the real rates and yield curve truly as a leading indicator of economic expansion or contraction, and we also saw that we can pull market risk out of using it. Now, as retail traders, we have access to certain bond products to look at U.S. Treasury websites. So you can go to the U.S. Treasury website and pull all the data like I did and put it on Excel and build a little slider. Or you can go to Fred's, which does it for you. Or if you're even too lazy to do that, you can look up SHV, which gives you the 1 to 12 month, SHY, which gives you the 1 to 3 year, and the TLT, which gives you the longer term. You can also check these out at etfdb.com, and it will show you that they're charted. So now let's discuss how we track corporate bonds and credit spreads, and how it shows us the impulse of the companies that fall in this economy, right? So we know that government bonds are used so that the government can borrow money from private sectors to spend on public spending, and corporation bonds are borrowed money from private sectors, and they let us predict the economy in equities, all it is simple debt issued by a company to raise capital for growth or operations, and then they pay it back by the end of the time period. It's just like your car payment, right? Now the yield is the premium paid against, an indicator that's based off the government bonds, right? So in this case, I'll be using the 10-year yield to compare against the corporate bonds, right? And so we know that the corporate bond market in the U.S. is the largest in the world. It's the most important debt market in the world because of the size, and the debt financing that these companies would rather debt finance rather than equity finance because it's cheaper and it's an easier way to raise capital, and it doesn't require selling parts of the stakes of the company, and then diluting the current stakeholders' value in their shares, right? So how they do it is, before the bond is even issued, they have to be checked for the credit worthy of the company, right? And then the price level of the interest rate is issued relative to the 10-year treasury, right? And that level will be evaluated and rated, right? So to understand this a little bit better, basically there's all these companies that check the fundamentals and the numbers of all these companies, and they give them a score. They give them a score of AAA, AA, A, triple B, double B, B, triple C, double C, C. And there's like a crap ton of companies out here that give them that, and that's their credit worthiness. And so now let's talk about credit spreads. Credit spreads primarily is when an investor raises the principal. It will allow it to go to the private sector, and it will trade effectively to the yield, right? So basically they're coming up with the interest rate based off the credit, which is the credit spread against whichever. So basically the yield is how much they're willing to pay you to let them borrow money, right? And factors that affect that is their creditness, which is given to you by the score, and that's based off of the microeconomics of the company. Then they factor in the economic conditions, how much liquidity is out there. They look at the business performance. They look at sector performance, like are people piling in on cyclical or defensive stocks at that time. And then they look at the benchmark rate. And the spread is the yield of the corporate bond versus the 10-year bond, right? And that shows us the GDP growth, corporate earnings, and it also shows us risk assets as a leading indicator. All right, so AAAs have the tightest spreads. They're the most highest quality company. They're the most highest quality bond based off their evaluations. And like I said before, there's a million companies out there that do these evaluations. I only trust the Moody, the S&P, and the Fitch. Those are the important ones that I focus on. But then like that AAA goes all the way down to CCC, which is the worst companies, with the largest spreads against that government yield or bond. And so basically, if they're a AAA company looking to borrow money, more than likely it's going to grow the company in a positive way. If they're a CCC company trying to borrow money, they're probably hanging on by a thread and about to go out of business, and this is the last attempt, which is why you get paid more interest to borrow the junk than the quality, because you're taking more risk. Okay, so let's look at this stuff right here. So we know the S&P is aggregated by 500 of the best stocks out there in the world, right? Well, these corporate bond indices do the same, and they're broken down into any way you need it done. So like if you want to see all the corporate bonds for a sector like finance sector, you can. But most of the time, they can be split up by the sector's credit quality. So high yield, junk, investment grade, like they all have their own, indices. So if we look right here, we can see that this chart is showing us a CSI AA, right? Or A. So that's double A's to double B's, and they compare them to the 10-year, and that's the spread. And what do we notice, Doran? Is that it's trading at 71 basis points over the 10-year yield, right? And it has big moves up during economic stress. And that requires pumping to happen, right? That means the economy is not healthy, so they're willing to pay you more money to lend them money. And so remember, the whole point of this is to use corporate bond indices to act as a leading indicator to risk assets like equities. Now, what we got to realize is the market is pricing the risk with these premiums. So, as you can see, the CSI A is supposed to be the healthiest companies in the world, right? But if the economic condition isn't healthy, the market has to price the risk in by giving you more premium to loan to them, so the Federal Reserve doesn't have to intervene. All right, so now look at the CSI BBB, right? This is the lower end of the mixed spread. The last one was your investment grade. This one is your high yields, right? And we can see very similar due to companies being more solid with better microeconomic factors. And notice the premium is more. It's 108 basis points over the 10-year yield than the last one, which was 71. So you get paid more because these aren't the most solid companies, but they're still pretty solid. Now let's look at the CCC spread over the 10-year Treasury. It shows the premium is 294 basis points. Now CCC jumps way faster and is way more sensitive than the other one, than the investment grade or the high yield. And you can see it tends to lead the peaks and troughs of liquidity, right? Because these companies are going to go out of business because the economic conditions aren't set up for their success. So like they're willing to pay you more to borrow more to try to weather the storm of whatever is happening. Notice the magnitude of the low to high during economic crises, right? The market knows these companies are barely hanging on, which is why they're forcing them to pay more premium for people to lend to them. The reason are the companies are trash, they have bad fundamentals, and then they're the most sensitive to going out of business. They need you to pay them for their survival. All right, so this is all done off of Bloomberg Google Sheets that I found on Google to kind of make it more visual. But like all this is public data. Look at this. You got the ICE BOA spread. That's off the Fred website. They refer to the same bond indices with the same rates, right? So the ICE, BOA, BBB, CCC, you have all of these that do the same thing. All right, so remember, the price of money affects the capital structure with equities plus debt around the U.S. If the cost of debt yields is blowing up, it affects mostly all companies because they have to refinance their debt. Remember, when money is cheap versus expensive. Now, the company's debt is costing more if the money's expensive, right? Because they're putting more of their revenue goes towards the liabilities, aka their debt, than growing the company. The market sees higher risk and they sell corporate bond yields and they go up, which entices people to lend to these companies, right? Now, market perceives lower spreads. They buy corporate bonds because they know it's going to feed into the equities, which will feed into the economy. So think of it like this. You have a job and you're paying your bills and you ask your mom for money, she's going to say no, right? Now let's say you lose your job and you can't pay your bills and you ask your mom for money, she's more than likely going to say yes. Then you're going to spend that money to pay your bills. But at the end of the day, think of equities in the economy as your bills. Think of corporate bonds as the account that your mom puts the money in. All right, so products that we can use, to see this from our trading platform. You got the LQD, which is the biggest and the best bonds in the companies. You have the VCSH, which is like the BB/AA. You got the HYG, which is your BB to C. And then you have your J and K, which is your triple C's. It's your junkiest, right? And what you have to do is you have to take these corporate bonds versus the 10-year yield, and it'll show you the risk. And you have to, it'll show you the risk, it'll show you the GDP, it will show you earnings, because it's macro. It shows you the macroeconomic breadth of what's going on. And you have to compare the historical events to see what levels make most sense of what's going to happen. And if you don't do that, if you don't cherry pick the data like that, then you'll get nothing out of this. But all right, I hope this helped, because I know this was very confusing to me as a new trader. But all right, later. For my own education as well, so if you have questions, please reach out to me. I'm on Twitter, Matthew W. Mickey 1, and we can work it out together.